Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome to the show where we interview the nation's leading real estate entrepreneurs. Welcome back to the show if you're joining us for a second, third, or 100th time, and welcome to it if you're joining us for the first time. Today, we've got Kyle Nott in the studio, and this is going to be an absolute treat for you guys because Kyle is an absolute expert at one of the lesser known strategies within real estate investing that can be utilized in pairing with life insurance, otherwise known as the infinite banking concept. Kyle has been deploying this strategy within his own real estate journey for over 7 years. He's been a real estate investor for over a decade, and we are going to hop right into it and have a great conversation. But before we do that, just remember, at Investor Fuel, we help real estate investors, service providers, and real estate entrepreneurs 2 to 5x their businesses to allow them to build the businesses they've always wanted, to allow them to live the lives they've always dreamed of. That being said, Kyle, welcome to the show today.
All right, glad to be here. Thanks for having me.
Yeah, I'm super glad you're here. I'm grateful to be able to get to know you a little bit, and I'm really excited to get to talk about today's topic since it's something near and dear to my heart. I've had a few different careers over my lifetime, and being in insurance at one point was one of them. And so I'm going to have a ton of questions coming your way. But before we do that and get started there, can you share just a little bit about yourself and how you got here for our listeners?
Yeah, so I kind of got into went to college, got a 9 to 5, did that thing, and I kind of had an aha moment. My dad told me to put 15% into your 401k and you retire a rich man. I'm like, okay, I'll do it. And then at that point, I got to crunching some numbers, and it's like, wait, I can never really enjoy this money until I'm old. Like, I don't want to work my whole life. I want to try to retire early. So I caught the real estate bug, and like, why not have someone else live in a house and pay all the bills, and then hopefully the house appreciates in value. I get all kinds of tax benefits from it, and I'm putting money in my pocket at the end of every month too. So that's like, okay, let's do this. So then I kind of it's been, like I said, over a decade ago. I started with my first house, and I didn't do it very well, but boy, do we learn from our mistakes real quick. And then it's like, okay, let's keep doing this. So kind of been chipping away at it over the years. I've bought and held most of them. I've had a couple problem properties. It's like, I don't want the headache anymore. So I have sold, I think I've only sold 2, but yeah, I made my way to 33 doors at this point, which is, for me, I never thought I'd be here, but everything's kind of working its way out, and I'm looking to put a couple more under my belt here in the very near future. So it's been a wild ride, and always fun.
Now, let me ask you this. When you first got started, you had that aha moment, right? What was your strategy back when you got started in purchasing these houses? Like, what was that real beginning stages for you like when you had that moment of, I'm not going to retire young, and I can't enjoy any of my money till I'm old.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
And I got to do something different. And then, like, what was that strategy when you transitioned to be like, I got to do something different?
So yeah, I've always been a diligent saver, and when I was finally, got out of college and I'm making some decent money, and I had a good little nest egg at this point, and it's like, if I take what I've got and I put it here, it's like, okay, I can do this, and then that's my down payment money basically. And I didn't really know and knowing what I know now, there's wholesalers and there's earnest money lenders and there's all kinds of other stuff you can, the zero down mentality. I never really got into that. I didn't want to. I kind of, maybe I'm old school, whatever it is, but I wanted to save up for that down payment as soon as I could get the down payment, and I'd go buy something. I've only bought a handful of properties that were off market. After you've been in the industry for a while, people know who you are, and you start to make some more friends, in different areas, and they will, believe it or not, start to bring you some deals that they're few and far between at this point. But back in 2012, 13, it was like shooting fish in a barrel. So I wish it was that easy still, but that was just kind of what got me going, and that's just the kind of the path I've been on. I didn't really want to go from 0 to 100 properties in a month. I want slow, steady growth is kind of my personality, and it's working for me. So I'm gonna keep on doing what I'm doing.
Love that. Now, so let me ask you this: when did you first come across the infinite banking concept, and what clicked for you about using it in real estate?
Yeah, so I'm saving, trying to get that next down payment, and I kind of made a little drawing on the board behind me. So I'll if you want, I'll bring my microphone over here too. But
Yeah.
what I would do is I would start and I'd save a little bit, save a little bit, save a little bit, and then whatever this time period is for everyone, it's different. So maybe maybe it's in years. My first couple, it would take me a couple years to save up enough for a down payment. But so you've got a little bit, if you're doing this in a savings account, you get a little bit of interest. Point oh nothing is what I like to say, but maybe you can find, if you got a bunch of money in there, you can find a little better rate, but it's basically terrible. So you build up, and by the time you get a lot of money, you're making some interest, but then you take it all down to almost zero, and there goes your down payment. But we bought a cash flowing asset, so maybe just throw out easy numbers. Maybe you use this. You bought a cash flowing asset, a rental house that you're cash flowing $200, and maybe this is $1,000 a month that you're able to save, and then now you're cash flowing $200 more a month, so you're able to build this up faster, and you've got your whatever your regular was plus your cash flow and a little bit more interest from the bank, not much, but a little bit, and then you build yourself up. And as soon as you got enough for the next one, boom, you wipe it all out, and now you've got two cash flowing investments. So now you've got maybe another $200, hopefully more, but um, just rinse and repeat, and you keep building yourself up to that ceiling. As soon as you get to where you want to be, you crash it all the way down to zero. Which there's nothing wrong with that. That's what I did to start with, and then it's like, okay, just I would I was doing construction, and I would have to drive from job site to job site, multiple job sites every day. And I figured out how to use the podcast app on my phone, and I started getting into real estate investing podcasts. It's like, holy cow. So I started learning about different ways to do that. There's nothing wrong with this. But then I came across the infinite banking concept.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
And that never really takes your money out. It always keeps growing. So that's kind of what this example is over here on this side. Um, Same thing. Now at this level is equal to that. I couldn't keep them to scale just because that is so much bigger than the savings way. But um, what this does over here is you're saving, but what you're doing is you're putting it into your policy. You're ramping up this policy, the cash value of the policy. And yes, there's a little bit of insurance involved because it is an insurance product and there's some parameters you have to, but you do have to have the insurance. But what we're doing is we're ramping this cash value up so fast that in the same time period, we're going to buy, say, a cash flowing asset. And what we're going to do is instead of taking the money out, is we take a loan against the value. Now, since we're real estate investors here, this is so much like a line of credit. Like if your house is worth $500,000 and you owe 250 on it, you've got 250 of equity. Basically, that's what this cash value is. This is an asset that over time is guaranteed to go up in value. Now, your house over history says it's going to go up in value, but it's not guaranteed. There's been plenty of time periods where it will go down, but usually it comes back, and that's what we're all hoping for. But there's dividends and there's guaranteed growth on this, so it is guaranteed to go up. And if you really ramp that cash value, whatever we're putting in to the saving side of it, put it into the infinite banking concept, then as this continues to grow, right here we're going to take a loan against our cash value. So whatever, say it's dollar for dollar, it's all equal. We're going to take a loan against it. We're not quite take all of it. We're going to leave a little bit in there, right? We're not going to take all of it. Now we have a loan against it. That money never comes out. So at this point, the money is still compounding. It's a daily compounding, and it's just compound interest is what they say is the eighth wonder of the world, right? Those who know it earn it, and those who don't pay it. So let's keep earning. As you take money, you don't take it out, you borrow against it. So the same time period, instead of building this up, we take and we lower. This would be our loan. We'll lower our loan. You don't have to completely pay it off, but once it gets really low, we've got another chunk of area that we can take another loan against it. So now we're right here. Instead of building back up, we take another loan, and now we've got two cash flowing assets. Again, the same. This was building up faster with two assets, with two rental properties. Now this, we're able to knock our loan down faster. So this is the loan that we're knocking down. We're knocking it down, but over time, my analogy I like to use is this is a lot like an airplane sitting on the runway. Here you're at a dead stop, and it's full throttle. It's a lot of work, and you're going. Pretty soon the nose starts to come up, and before you know it, I mean, you're just taking off and you're flying. So this is not someone who wants to buy one one rental property in the next 5 years and be done with it. This is someone who I'm the kind of person I want to keep slowly adding over time. And for those kind of people, when I saw this, that was another super aha moment. It's like, holy cow, this cash value is going to keep growing and growing. And that it's also insurance. If I happen to die right here with a big loan out, the death benefit that's up on the ceiling. That's off the board. So this is just available cash value that you can use while you're still alive. But if you happen to pass away here, well, this is what your family gets. And if maybe they get your assets over here, it's the same thing. They still get your assets. And if you pass away here, I mean, the death benefit is going to be.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Way above what your available cash value is. So it's kind of a way of accessing some of your death benefit while you're still alive. When I first did this, I didn't need life insurance. I had a term policy, whatever, to take care of the kids. But it's like, I set this up and I didn't even care about the death benefit. But then you go to look and it's like, this is way better insurance than the term I was paying anyway. So I just let the term go. And as long as I keep using this to buy more assets, you've got the insurance in place. But I never even thought of it like that. I just want to use this as a tool, as a vehicle, in order to be able to buy more and more assets. And the big thing here is once you pay these off, same thing. Save back up. Instead here, now you're paying off. Once you get over to this side of it, in the same amount of time, then we've got 3 cash flowing assets. Over here, you have 3 cash flowing assets, but you only owe this much. You could literally buy probably 3 or 4 more the next year and just pay all those back off too. So it's just a different way, kind of inverting, getting away from the banks, making your own banking system. As you can tell, I'm pretty passionate about this stuff. I love it. So, what questions you got for me?
Absolutely. I actually don't have any questions. I have something to add, actually, before I ask my next question. And that piece is the other thing that you didn't touch on, which is also super important, is on that one side with traditional savings. Again, you have the life insurance that's in place that if something happened to you, like you said, you pass away, they get a death benefit, right? What happens oftentimes with traditional savings, though, is let's say you were having that savings. If you don't have your will set up properly, if you don't have a trust set up properly, if you don't have some of those other financial pieces set up anyways, well, what happens is people think, oh, well, dad's got enough money in the bank account, so if anything happens to him, I don't need insurance. Well, the downside of that is if that goes to probate and you can't access it for 10, 11, 12, so I've seen some as much as 18 months. If there's multiple people involved with the final arrangement process, that can get messy depending on if you've got a greedy family member. So like the life insurance gives a tax-free payout when that death occurs eventually, because ultimately it's a whole life policy. So with that, it's going to take whatever loans you might still have withstanding, subtract that from the actual death benefit, and then still pay out. So it's a much better financial protection piece for you as well if you are in that space and if you have assets. So I wanted to add that because you didn't touch on that. But my next question would be and this is for our listeners' sake, is can anybody do this?
So you have to be insurable. This is one of the reasons I put a policy on my life 7 or 8 years ago, and then I got into this like after like 4 or 5 years. The money I put in, at that point, I could then borrow more money out than what I had put in. From here, for the rest of my life, I will always be able to take more out than what I put in, just because of the dividends and the guarantees that comes along with this. And so I had a couple family members that had cancer. My sister-in-law actually passed away from melanoma, skin cancer. And at that point, no one's really going to give you life insurance anymore. So
right.
We had a couple of health scares within the family, and one was, the worst possible outcome. I went and put a policy on each one of my kids. And now my kids don't have jobs and they're not producing a lot of income. So there's different ways and there's limits on what you can do. I could put a lot more insurance on my life than I could on theirs, but I went and started one of these policies for each one of my kids just to get it going. And they're going to, their runway is so much longer. I started mine when I was 37 years old. I started theirs when they were, my oldest kind of got screwed because he was older, but my youngest was, I think, 7 years old, 6 or 7 years old. So, I mean, he's gonna have and I don't know, they probably won't watch this. They have no idea that it's even out there. So at some point, maybe at their wedding, I can gift that to them. And here's what kind of a wedding present is that? Here's a multiple hundreds of thousands of dollars that you can borrow against, and of course I'm going to show them how to do this. So you have to be insurable, but if you are not insurable yourself, maybe your wife is, maybe your kids are, maybe your grandchildren are, someone that you have an insurable interest, a business partner. So there are ways. It does not have to be you if you are uninsurable, but it is an insurance product. So yes, we have to find some insurable interest that can get the insurance in place.
Can you go a little bit deeper on what being insurable means for somebody, like some of the things that they might not realize?
Yeah, so like I kind of touched on the health part of it. What they do is when it's life insurance, so the actuaries come in, and it's still a business that the insurance companies still, they want to make money. It's a profitable business, right? So the businesses, the insurance companies that we work for, they're all mutually owned, so that's how they pay the dividends. So that's what really helps with this. You don't really want to do this with a stock owned company. People might sell it that way. There are a lot of agents out there that claim oh yeah, I know all about this, and they'll sell you something which actually pads their pockets a lot more than the infinite banking. But there's yeah, you've got to be insurable, and to do that, it's through the health. And like I said, they're going to go through the actuaries. They're going to figure out basically what your life expectancy is, and so with that, they're probably not going to take anyone that's had previous, a cancer scare. Um, I had someone come to my house, and they drew my blood, and they went through all of my medical records, and they are going to dig into it a little bit. That's why, you want to find someone that's healthy, that you'll get the best insurance premium rates. Not to say that this still won't work, but you're going to be paying a little bit more for the insurance itself. And what we like to do is, I get as little insurance as legally possible, and then I ramp the cash value up on top of that as much as legally possible. So you're kind of playing a fine line depending on where your health is, and if you're into skydiving or rock climbing, bungee jumping, that kind of stuff. The life insurance companies don't want to insure you against that kind of stuff either. So, but if you're a boring old dad like me that maybe I'll go out and run a little bit. That's about as exciting as it gets, watching my kids go out. But um, that kind of stuff, you had decent health, you're insurable, that you've got no problem. And that they didn't do anything with my kids. They didn't draw their bloods. Like, oh, they're kids. We know what their life expectancy is, and they set the premiums, and I ramped that up as much as I could. I think I'm paying about $5,000 in premium for each kid per year, and mine I wanted to get as high as I could possibly go, and I'm putting $20,000 a year on mine personally. So that's when I set this up. That's where I was at, what I could do, and yeah, like I said, you want to get that as high as possible, and things might change down the road. Hopefully, here in another 10 years, I'll be rolling in the dough, and I'll be able to up that. And I totally I just had a grandson about 6 months ago, so I'm looking at maybe putting a policy on him, and just it's endless, I think.
Yeah, well, it's infinite, right? That's what it
That's
really
right.
is.
That's right. Someone told me the other day, it's an infinite learning correct. Yep.
You bet. Well, congratulations on the grandson. So, another kind of a follow-up question that I have there too is, people hear, oh, you're putting $5,000 on your kid, you're putting $20,000 in. Like, how much money does it actually take to really start doing this? Like, even if somebody only has 100 or a couple $100 a month to even start with, is it still worth it to do that?
Totally. You could start where you're at. I know that I throw my numbers out for where I'm at, and I've heard of people that will probably $5,000 a year would be, and not that that's a hard floor, but it's going to take a little bit to get everything going. So I would say if you could do about 5 grand a year is probably the minimum ish. If not, maybe try to get there and get above. But I mean, the Rockefellers did this, and this is what they do to continue their family name. And what they did is, I mean, obviously Rockefeller was a multi millionaire, so he had the trust own. He was the owner of the life insurance policy, and every child or that came from him, right? If he's at the top of the family tree, every child was provided insurance policy that the trust paid for and the trust owned. And so that's, you hear of trust fund babies. I mean, this is where it came from. But with that, I don't intend to raise trust fund babies. I intend to teach my kids, what kind of a valuable tool this is. But so that's how the Rockefellers did it. They just kept on rolling. It kept on rolling. So when someone dies, the trust then gets the death benefit, and then now the trust just got bigger. The trust, if he had 4 or 5 kids, the trust would pay for insurance policy on each one of these, and that is essentially what the Rockefellers have been doing. And this has been, I think, until recently, probably the last 10, 15 years, until this kind of, the internet probably exposed some of this. It used to be a super secret for just the wealthy, but it's really afforded to anyone who can maybe scrape together $5,000 a year, can put this policy into force, and it'll help you grow. And in 10 years, you get another policy, and you make it more.
And to be perfectly frank, I still think most people don't know about this, or they've heard about it and they just don't care enough to research into it deeper. So I still think it's something that really only the wealthy, either in physical format or mental format in terms of their mindset, I think are still the only people that are actually accessing this, because some people hear about it and go, well, I could never do that. You know what I mean? But ultimately, I think
have to take a little bit of action. Sorry, go ahead.
No, you're good. Go for it.
I'd say you have to take a little bit of action. And like I said, the Rockefellers, they just teach their kids about it, and you take a little bit of action. It took me forever. I mean, I probably dove into this for 6 months, and I'm talking to the guy that, my agent that got me the policy, and I was just drilling him. And I think he learned just as much about this whole thing, because I asked some super off the wall questions. And he came back and answered them all, and was like, all right, let's do this. And I'm the type, I'm gonna research it, I'm gonna figure it out, but I know I'll never know everything, and I'm gonna learn the most by just trying it. And about like that 4 or 5 year mark is like, okay, I can now take a loan out for more money than I actually put in, and as long as I keep paying these premiums, this is good forever. There will always be way more. I mean, I think by the time I'm to the end of my rope here, and even in my 90s, I think I'll be able to take the most I'll ever put into my policy could be $210,000. I'm going to keep going after that, but I could take like 2 million out in my 70s or 80s like that. So it's crazy what this thing is possible.
Did you say, just to clarify, did you say the most you can actually put into it is 210,000?
I could. So the way I set mine up was
is that per year or just like total?
Total. So the way mine was set up was I was going to overfund it the first year. I put $30,000 in. I was getting ready to use that as a down payment on the house anyway. So I put it in here first. I waited about a month, and then I think I took about 20 out, and I used that as a down payment. So that was kind of what got me going. And then mine is a 10 pay, where the way I set it up, the only thing, I only have to pay this for 10 years. So the way it's structured, 30 the first year, 20 the next 9. So that's $210,000 is all that I put into it. Now I'm going to keep putting, I'm going to continue to ramp this cash value up. But I was like, okay, let's do this, try this for 10 years. And I was done. So from there, the way it was structured is all it does is it takes a loan from my policy and it pays the insurance part of it. So my insurance will never, will never be interrupted. So that's obviously what we need to do. And it's growing exponentially on top of even these little loans that maybe I never even intend to pay back. So that was the way mine was set up. And there's so many different ways that you can set these up. They're so personalized. What are your goals? Maybe not everyone wants to buy a house every year or every 5 years. Maybe you get to some point where you want to pay for your kids' college. This is a perfect way to pay for your kids' college, because you can list it as an asset if you want, or don't if you don't want. So kids' college is a perfect way. The FAFSA form, when you fill out your FAFSA form, you don't put that on there. There's people that have $10 million of cash value and they don't put it on their FAFSA form, and they're getting aid from the state, or however the federal aid from the college board. So there's ways now. If you're going to go get a loan from a commercial loan from a bank, and you want your assets to look as good as possible because you're trying to buy a business, and go ahead and put it on your statement. So it's kind of one of those things that's it's insurance, so you can kind of put it where you want. It's from creditors that say, you get a lawsuit and something bad happens, maybe you don't have the LLC set up right, and someone comes after you personally, lawsuit's gonna, all right, give me that savings account, I'll take that. And that's just there. I mean, you've got, depending on what state you're in, you've got so many more protections on your life insurance, where they really can't access that cash value. So that's another positive. I could go on and on about. I think that's way so much better than the traditional
Right.
savings. And that was the hardest part for me to understand too. I couldn't get my head wrapped around it. Like, what do you mean? Like, it always, you never take the money out. You're only borrowing against it. So it's like your house will, like I said, continue to appreciate in value, even if you have a home equity line of credit pulled out, and maybe 5 years down the road, your house appreciates another 100,000, and you could pull another $80,000 HELOC out of it. That's kind of the same concept.
And also, to maybe touch on one other point here, you mentioned doing a 10 pay, which for our listeners basically means that you only have to pay for 10 years. Most whole life contracts are set up where you're going to pay a small marginal amount every month, regardless of your age, to eventually pay up that whole policy, and then you're actually going to pay a whole lot more into it over time. But one of the things that you have to avoid when you have a smaller monthly premium is the amount becoming what's called a MEC, or an MEC, which is a modified endowment contract. So doing a 10 pay, and correct me if I'm wrong here, Kyle, because you are a little bit more of an expert on this this particular space than I am within the insurance niche. But by doing a 10 pay, it allows you to put a much higher amount into that policy, with it being a straight whole life versus an indexed universal life policy. And still get the same benefits, while also being in a position where, hey, after 10 years, I don't actually have to pay a premium. Technically, is that correct? Or tell us a little more about that.
Yeah, the MEC limits, like you said, a modified endowment contract. So
which is a taxable situation for those that don't know.
Yep. So what Congress kind of did way back when is said, wait, this is too good to be true. So all these multimillionaires are throwing all kinds of money in it. It's like, wait a second, hold on. So that's why the MEC limits, an endowment contract, there are limits. So they kind of look at the first 7 years, and that's why every situation is so different. And if you're interested in something like this, I'd be happy to help, or you, or whoever else. Just make sure they understand this concept. And there are certain criteria that we need to check off to make sure that you don't go into that modified endowment contract by putting too much money into there. So usually what you want to do is you kind of max out. You look at the first 7 years, and you max that out, and from there you're usually good to go. So there's a couple of tests that we can look at, and like I said, everyone's so different that it's hard to really speak to a broad audience. But yeah, I just kind of know where you're at, and then max it out from there. And after time of usually after time, look at it again in a decade, and you can usually do more at that point.
Right. Man, I'm telling you what, I'm going to have to go start another podcast that has longer episodes, because we're already over the time that we usually try to cut these to. And I still am not done asking questions, but just out of respect for our listeners and everything we've got going on to keep things consistent at the Real Estate Pros podcast, I'm going to wrap it up. But before we do that, I want to do a quick speed round with you. This is something that I wish I had a button that I could start some game show music. Started doing this on the show this last week. People seem to really enjoy it. Guests seem to enjoy it. But it's just a rapid fire speed round of questions that I'll ask you with the shortest possible answers that you can give. And then the last question is a little bit more of a thinker for you to answer a little bit slower. Take your time with, and then we'll let people learn where they can go and connect more with you and wrap up the show. You good with that? You good to play?
I'm getting nervous, but yeah, let's go, man.
All right, let's do it, Kyle. Do. All right, what's your go-to insurance company or policy type?
It'd be obviously IBC, Mass Mutual, or Penn Mutual.
Awesome. How fast can you get a policy loan into your bank account?
2 days.
Do you repay your policy loans or let them ride?
I always repay them. I want to keep doing this.
What's one mistake people make when they start their first policy?
They don't fund it high enough.
Favorite resource to learn more about infinite banking?
YouTube.
And the last question, if infinite banking no longer was something you could use, what would you do then?
I would go back to the velocity banking where I would use my home equity line of credit and repay that.
There you go. Boom. Well, you heard it here first, folks. I know you probably got a ton of value out of this as much as I did. So, Kyle, if people want to connect with you and learn more about you or what you're working on, where should they go for that? I know you have a YouTube. Feel free to plug that and anywhere else on social media or other channels.
Yeah, I'm started a YouTube channel last year, and as you can tell, I'm passionate about this stuff. So check me out. I am not your average finance guy, and my last name, I'm Kyle Nott, N-O-T-T. So kind of a screwed up. I probably should have picked a different name, but it's N-O-T-T, your average finance guy.com, and that's where I'm at on YouTube as well. So I've got some free resources on my website. It's not very fancy. I'm not a tech guy by any means, but go check that out if you want some free stuff. And check me out. YouTube videos are not all about infinite banking, but a lot of them are. And yeah, reach out. I am connect@notyouraveragefinanceguy.com is my email. If you ever got any questions, I'd be more than happy to help and see if we can guide you in the right direction.
That's not with 2 T's, folks. Well, Kyle, thanks for being here today. And everyone, I hope you enjoyed today's show. We'll see you on the next episode.
Appreciate it. Thank you.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.